I've been investing for more than 15 years. During that time, I've made a ton of mistakes, and I often think to myself, what do I wish I could teach my younger self about investing? So I put together a list of 10 things that I wish I could teach my younger self. Here we go. Number one, personal finances come first. If you're an investor, there's going to be periods when the market just goes down hard. Typically, when that happens, the economy is not doing well. And during those times, you're going to be very stressed out. The news is going to be crazy. You're going to be worried about your job. In those cases, that is when it is the best time to invest. However, it's impossible to do so if you have a mountain of debt and very little cash on hands. This is why I stress to people that your personal finances are more important than your investing finances. If you have tons of debt, if you have one source of income, if you have very little in cash, work really hard to make sure that that is right-sized. Pay down your high-interest debt, build up an emergency fund, and develop multiple sources of income. If you can do that, then you put yourself in a great position to be a buyer when stocks are falling, and you won't ever have to worry about freaking out and selling. So the number one tip is make sure that your personal finances are taken care of first. Number two, capital is precious. When I first started investing, I bought garbage. Penny stocks with dividend yields over 20%. I did absolutely no research, and thankfully, I got my teeth kicked in. I say thankfully because I was happy to make those mistakes when I didn't have a lot of money. Those mistakes would be much more expensive if I was making them today. But I've since learned that your capital is limited. Be very selective with what companies you choose to invest in. Develop a checklist for yourself. Make sure that the companies that you're buying meet the majority of the criteria that you set out for yourself. If you don't have a checklist, borrow mine. Borrow Brian Stoffel's. There's a link that you can click to get access to our checklist. But whatever criteria speaks to you, make sure that you demand that your companies meet that criteria. They don't have to meet all of it. They have to meet the vast majority of it before you put money in. That's exactly what I do with my capital. I want my money in the highest quality companies that I can find for as long as possible. And if it's anything else, I just ignore it. Capital is precious. Number three, your biggest edge is patience. Wall Street has better information than you do. They have better access to management, they have faster computers, and they can trade way faster than you can. As an individual investor, your biggest edge is your ability to be patient. Wall Street can't do that. They have to worry about meeting quarterly numbers and reporting to their investors and meeting short-term goals. My only edge as an individual investor is that I have nobody to report to except for myself. That allows me to be patient with all of my investments. If a company has a stock really declines for a quarter, 6 months, a year, I'm okay with that as long as I believe in the long-term thesis of the business. But if you become focused on short-term trading, you give up your biggest edge that you have over the rest of the market, which is your ability to be patient. In fact, in the long term, the thing that really matters with how well you're going to do is how long you invest for. That's the number one factor that outweighs all other factors combined. Remember that. Patience is your biggest edge. Don't waste it. Number four, don't be in a rush to sell. I have made so many mistakes in my investing career, but all of my biggest mistakes all have one word in common: sell. I sold Dexcom for $8 per share. I sold Microsoft for $24 per share. I sold Insulet for $17 per share. All of those sell decisions were done, and then the stocks went on to multi-bag, 10x returns from there. My decision to sell those great companies very early because I was in a rush to take a profit cost me way more in the long run than all the other mistakes that I've made combined. Because of that, I've learned to become extremely patient with my investments. In fact, I think it's a much bigger mistake to sell a potentially big winner early than it is to hold on to a loser for too long. Because of that, I have a natural aversion to selling, and that will prevent me from selling the next multi-bagger that I get. So develop an aversion to selling and don't be in a rush. Number 5, watch the business, not the stock. If you watch the financial media, or you pick up a newspaper, or you turn on the news, what's the thing that they talk about as it relates to the stock market? The price. What's the price of the Dow Jones today? What's the price of Apple today? What's the price of this stock? Everybody is hyper-focused on the stock price because that's the thing that moves around. I've learned that what really matters in the long term is the business behind the stock. Because of that, I pay very little attention to the day-to-day movements of the stock market. It's going to go up, it's going to go down. That's just what the stock market does. I focus my attention on the earnings reports of the companies. Is revenue growing? Are they adding customers? Are margins enhancing or improving? Is the balance sheet looking good? Have they made any new acquisitions or launched any new products? Those things matter and drive long-term returns. And if the company does well, the stock will eventually do well. Because of that, I really believe that you should focus all of your energy on watching the business and do your best to ignore what's happening to the stock. Number 6, add to your winners, not your losers. This is one of the most counterintuitive lessons I've had to learn the hard way. If a stock is going up because its business is going up, that can actually be a great company to buy more of. The old me always looked for what stocks that I owned that were down, and I wanted to add more to my losers. They were down typically because the businesses weren't doing well. Maybe a competitor was coming in and was eating their lunch. Maybe they weren't fulfilling or executing as well as they could have. For that reason, their stock was being punished on Wall Street. Conversely, I own plenty of stocks that are really executing well. Wall Street's catching on to the growth story and the stocks are performing very, very well. In those cases, it's really hard to get yourself to buy more of a stock that's already up. However, many of the best buys that I've ever made in my investing career were on stocks that I already owned, and I was adding to them at higher prices than on my initial purchase. Again, that's really tricky to do, but winners tend to keep on winning and losers tend to keep on losing. For that reason, I'm a big believer that you should add to your winners. Number 7, do nothing is almost always the correct thing to do. It's very tempting if you're looking at your portfolio to want to take action, to want to buy something, to want to sell something, to want to trim, to maybe set up an options position. All those things are very tempting. In reality, 99% of good investing is doing nothing. The other 1% of the time is researching and buying great companies. If you have put great companies in your portfolio, the right thing to do almost all of the time is nothing. If the company produces a stinker of an earnings report, or there's some bad news that comes out, or if the stock goes up for great news, whatever is happening, the almost always the right thing to do is nothing. So develop a laziness to your investing approach. I know that sounds counterintuitive, but in my opinion, I think you'll do better in the long term. Number 8, know what valuation metrics matter, when they matter, and when they don't. This is a really hard concept to get across. When I first learned about the price to earnings ratio, the PE ratio, I wanted to apply it to every company all the time. And that kept me from buying lots of great companies because I saw that their price to earnings ratio was 100 or 500 or 1,000. And how on earth could that be a good buy if its price to earnings ratio was 500? It turns out that depending on what phase a company is in its growth cycle, different metrics should be used and some metrics should be ignored completely. For example, in this chart here, it shows that if a company is in the launch phase and it's still losing money, but its sales are ramping up quickly, you can't use the price to earnings ratio because there's no earnings. The PE ratio doesn't apply. The best ratio that you can really use in those cases is the price to sales ratio. But even that has some flaws, especially if the company is right after launch. In the hypergrowth phase, when the company is really taking off and it crosses into profitability, that's when it's also a mistake to look at the price to earnings ratio. The reason is the company isn't yet fully optimized for profits. Therefore, the earnings, the profits, are going to be artificially low. That means that the price to earnings ratio is going to look artificially high. It's only when a company enters stage 4, when it's fully optimized for profitability, that you should start to look at the price to earnings ratio. In 2021, those are companies like Apple, like Procter & Gamble, like Coca-Cola, companies that are big, established, and fully optimized for profits. Those are great companies to use the price to earnings ratio on. Conversely, if a company is in stage 5, if it's in a secular decline because it's being disrupted, no valuation metric should be used. That company is heading towards irrelevance. And that happens all the time in the business world. So don't universally apply the price to earnings ratio or the price to cash flow ratio or the price to book or any of those metrics to all companies. You have to know when to use them and when to ignore them. Number 9, you're going to be wrong a lot. I don't care how much research you do up front. You are going to be wrong with a certain subset of your investments. A few years ago, JP Morgan produced this wonderful study where they looked at thousands of companies over a 30-year period, and they said, what are the odds that any given company will beat the market? Well, the results surprised me. It turns out that only about 1 out of every 3 companies goes on to beat the market, and about 7% of all companies are mega winners, and they really drive the returns of the market. That means that 2/3 of the time, companies are going to underperform the market and even perhaps be a big loser. Just playing the odds, if you buy 10 random stocks, you can expect that 6 of them will be losers, 3 of them will be market beaters, and 1 of them will be exceptional. That's just the odds, and that's just how it works. Your goal as an investor is to improve the odds. I think that's what my checklist does. My checklist increases my odds of buying a winner and decreases my odds of buying a loser. But even if going through all the things that I look for in investment, I know that I'm still going to be wrong a lot because the business world is dynamic. You need to accept that up front. You don't have to be right with every investment to do well. You just have to be right with a few of them and really hold on to your winners to outperform the market over time. Number 10, don't invest alone. When the markets are cratering and you are by yourself investing, it's really hard to keep your head on straight. But if you are involved with a good community, and good communities are big, like people on FinTwit, the Motley Fool, Ian Castle, and Microcap Cub. There, it is so much easier to keep your head on straight and make good investing decisions. So don't invest alone. It's not you versus everybody. Find other investors that invest the way you do, that like the companies that you do, that think with the time frame that you do, and befriend them. Reach out to them. Learn from them. The community is an invaluable resource when everything is going downhill. Well, thank you for watching this. I know that I'm going to continue making investing mistakes for the rest of my life. However, I do believe that if I knew these 10 lessons when I first started out, that I would do much better over time. I promise I'll be making more mistakes to come, and as I make them, I'll be happy to share the lessons that I learn with you. Thanks for watching.